Hello, and welcome to the Gold, Goats, and Guns podcast. For today, June 5th, 2024, it's Ubik Day, folks. And for those of you who don't know what the fuck I'm talking about, Philip K. Dick's seminal novel, Ubik, was set on June 5th, 1992. And this was a book that I would read every June 5th to remind myself that the world of simulations that we are told constantly that we live in, it was all predicted. Everything we're living through today was predicted brilliantly in Phil's novel. And so I get the great pleasure. Not only did I get to do a market report for my patrons this morning, celebrating what I call Ubik Day. I'm the only guy who considers today a holiday. But I get to sit down and I get to chat with my good friend Vince Lanci, who's here to discuss where we are, considering that we're in the middle of what I would consider one of the biggest narrative, like needle scratch jerks of all time, on the eve of the planned rate cut by the ECB, and how the ECB is getting ready to diverge from the Fed, who refuses to cut interest rates. Now, for those of you who've been following this podcast forever and a day, and I'll get to Vince in just a second, you know that I've been describing the whole fight between the global central banks as a race. Who cuts first loses. And so tomorrow I get to celebrate, break my hand, patting myself on the back by saying the Fed wins because the ECB is going to cut. Well, in the interim, what we've seen in the last week since the Donald Trump conviction, sham conviction, whatever you want to call it, we have seen an epic move in bond markets and currency markets and stock markets over the last 4 or 5 trading days, which I can only... The minute I saw this unfolding on the eve of the ECB rate cut, I'm like, there's only one person in the world that I want to talk to, and that's Vince Lanci. So Vince, thank you. We've already chatted for an hour and a half about every other thing that's going on in the world. So We'll see if we have any energy left to actually do this podcast. Really great to have you on, and great to talk to you about all this stuff.
Thank you for having me, and I appreciate the words. But yeah, we're gonna get into the spider web that is the European Central Bank and what they're doing. That's right.
That is one way of putting it. The other way of putting it is that Christine Lagare has now gotten her thumb caught in a Chinese finger trap because she previously only had 4 fingers trapped. That's the way I've been describing it for a long, long time. And I don't think she has any moves left. So when the ECB came out last week and they said, hey, we're going to cut interest rates because, well, disinflationary effects have taken over and we think we've beaten inflation and blah, 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 blah. I'm like, yeah, that's all bullshit. What's really happening is, because if we go back to March when the Swiss National Bank cut rates, I noted then, I don't know if you and I talked about it, but I noted then that, oh, look, they're cutting, the SNB is cutting interest rates and weakening the Swiss franc because of multiple reports that were coming out that the Bundesbank was in serious trouble in Germany. And there were multiple reports coming out of Bloomberg that German banks were heavily exposed to weakening and failing commercial real estate debt because they loaded up on a ton of this stuff during the NERP years in Germany in order to get 8% yield to pay their pension funds. And then lo and behold, the SNB comes around that, in previous times passed down the Jody described to me as the wholly owned subsidiary of the Bundesbank, the old Swiss banker that he is. Yep. And he was not wrong about that. So I wasn't shocked by this. And now here we are a couple of months later, and the ECB is finally having to say, almost throw in the towel. And I think I know why. And I'll leave that. We'll have that discussion later because we're on the edge of the European parliamentary elections, which are this weekend coming up. But I don't know when I look at a 30 basis point move in the US bond market in 5 trading days, I don't know about you, but what little hair I have stands on my head.
Right. So. Well, I mean, to start off, I mean, we've approached, look, we talked for an hour and the hour that we talked, a big part of that before we started recording was finding the commonality and the contradictions in the thought process. We have come to similar conclusions from different perspectives many times before, and that's what's happening again today. So here's my 2 cents. Before talking to you about this, not having any thought about this ECB stuff and this tinfoil hat shit. I have my own flavor of tinfoil hat. I have been seeing in my inbox an increasing amount of research reports and commentary that were calling for recession. In fact, I wrote about it in a post yesterday. I said there's an increasing amount of concern about recession, and lo and behold, this was the first day that the bond yield strengthened. Right. So I'm sorry, the bond market strengthened. And so stocks were down 4 days, and then the bond market was down, and then the bond market starts to rally. And all of a sudden my inbox is flooded with, look out for the recession. And I don't mean like mainstream media people. I'm talking about respected economists who I read and I like their stuff. Some of them I think are quacks, but some of them I read them anyway, even though they are quacks, because I want to know the quacks that are steering money, what they're doing. Anyway, the point is, I had been reading them, and I went, wow, everyone's really fucking, like, all of a sudden, everyone's talking recession. And I had thought, completely separate from me, I'm like, wow, they really want the Fed to cut before the election. I was thinking domestic U.S. Biden Davos division. The dots that I threw out there in my mind were okay, elections coming up, recession's on the table now, and they're all talking about it. Goldman, like American banks, not just European banks. I'm like, right. They want the Fed to ease, and it's kind of like, the message is getting out there, and the disinflation message is getting amplified. It's like, you've got Trump guilty. Let's move on to the economy now. And now the message is, let's hammer the inflation is dropping, and whether the inflation is dropping or not is irrelevant to me. It's the fact that they're hammering it now, and this is in the circles that I read and I look at. And then these reports start coming in, and I'm thinking, by the way, this is entirely domestic. So in my world, I'm thinking, well, he's not going to ease. Powell's not going to ease because he doesn't want to be political. He's not going to ease because he wants the hard data. He may get the hard data, the lagging data, the big data, to make him be able to ease a month, 2 months, 3 months from now. But as of right now, he's not going to ease. Nothing is broken. Why would he ease? Nothing is broken that he can't fix with a sniper rifle. So that's where I am coming to this. And I'm still looking at the potentiality of the U.S. doing yield curve control, which they will, just not tomorrow. In order for them to do yield curve control, the Fed, the bond market has to get even worse in the U.S. And so right. 3 days ago, when gold took a dip, I hedged my portfolio, my speculative portfolio, by buying bonds. I traded TLT versus GLD a lot for macro. Like, I'll buy both, I'll sell both, I'll buy one, I'll sell the other. And I bought bonds, and I'm like, I'm probably going to get my ass handed to me here. But if we really are in a disinflationary cycle, then I want to own some bonds, because as Hartman said last week, one of the guys who's talking recession said, well, the Fed's probably going to ease, and you're probably going to see bonds rally for cyclical reasons. He said this before you and I were talking about this. I went, all right, so there's too many shorts in the bond market. Disinflation is back in the news. Recession fears. They want Powell to ease. He's not going to ease, but bonds are a buy. So I bought bonds. And then you and I have a conversation. I'm not looking at Europe at all. Like, it's totally off my radar. And then you tell me that it's Europe buying the bonds. And I go, holy shit. So that's where I plug in to from the US domestic world. I come to the conclusion that yes, whether they're working together or not on this, the US bond market is being bought. Everyone and their mother is trying to telegraph recession, and we want the Powell to ease. And so now we get into what you said, and I'm like, yeah, this fucking makes perfect sense.
Yeah, no, and to be honest with you, Vince, what you've just done is you've brought in what was going to be the second part of my punchline, but we'll go there first, which is that, of course, part of the rug pull is that we had to sit there for the first 6 months of the year, or 5.5 months of the year, and go, oh, the economy is not so bad. Bidenomics is working, and the inflation is falling, and the gasoline prices are under control, and blah, 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 blah. And now it's going to be evil Powell is killing Bidenomics because he won't cut interest rates because the recession is here. The flip is already here. You just described the mechanism of it, how they're going to shift the Overton window on this, right? How they're shifting their narrative strategy, when the reality, and that's part of it. And you're absolutely right. It's like they never do just one thing, right? They're doing multiple things. They're trying to win the election. They're trying to get rid of Powell. They're trying to save the ECB. They're trying to save the euro. They're trying to institute global communism. They're trying to start World War III. All of these things. And the solve on all of these different, as I would put it, differential equations is force Powell to cut.
Right.
How do we force Powell to cut? You can't.
Right.
Unless you break something.
Right.
Okay. So
and
now
they can't afford to break something going into the election.
Exactly.
Now they're kind of stuck.
This has been my thesis as to why Powell wasn't going to cut all year long. It was a big game of chicken. Oh, we want you to cut 7 times. Go blow me. Well, how about 5 times? Blow me. How about 3 times? Okay, just pull it out and play with it a little bit.
The hand job. Yeah, exactly.
Like, this is where we are, right?
Right.
And then he's like, yeah, never mind. Blow me. And he was the last time he spoke in public, it was hilarious.
I know.
Again, over and over and over again, Powell doesn't change and everybody just reacts. So one of the ways to look at this is that it's the best way to get people to get, how do you get narcissists to go crazy?
Ignore them?
You ignore them. Exactly. Right. So he ignores them. He keeps doing what he's going to do. Nothing's broken. 5.5%. I've got lunch at, I'm having lunch at the
hold the fucking door. Close the fucking door.
Close the fucking door. Exactly. And I got work to do, and that's it. So again, this is where we are, right? And so now tomorrow the ECB is going to cut. Now, why is the ECB cutting? It's not because inflation is down.
Right.
It's not because It's not because Europe's economy is in good shape.
That's before you get into this, because I know you're about to go off and explain.
No. I'm going to leave this for you to talk about.
But this is, I'm just approaching it as I'm slowly crossing the pond, and I was like, wow, I can't this is me before we talked. I'm like, I can't believe Europe's going to ease. And I rationalized it, again, not seeing this chart you just gave me about how the Eurozone is buying all these treasuries and how their own RRP is exploding. I approached it and I went, how is Europe justifying easing if the Fed's not going to ease? And then I went, all right, maybe Europe is, and I know that they're no longer pals anymore. Maybe there's a little bit of frenemy thing going there. And I went, okay, maybe the war is really bad and their economy is bad and they want to lower rates. And then I went, well, in fucking 5 months, it's going to be wintertime and natural gas is going to be through the roof. And they're going to be stimulating economies and giving people, shutting off power. How are they lowering rates now? And the answer I came to the conclusion to was they hope the Fed's going to ease. They're going to be disappointed. That was the first thing I said. And the second thing I said was they can't pay their interest expense, or they're tired of paying their interest expense, which is the same pressure that Powell's been getting. And so I come to you with that, and then you just hit me with these charts, and I go, oh shit, Europe is actively trying to push our bond yields down. It's fucked up. So you've got to run with this. I mean, I've got to,
Oh, no problem. So what I'm talking about here is before we started recording, I showed Vince, this is a version of this chart I published in previous articles and whatnot, but it's the cumulative change in the Treasury International Capital Report of U.S. Treasury holdings by central banks by region. I've broken it down by region. I've had the Eurozone and all. And I put things like Canada are in the Eurozone because they work for the crown. And by the way, the Bank of Canada cut this morning by 25 basis points. Right. You have Bermuda and the British Virgin Islands and the Caymans and Luxembourg and even things that aren't part of the EU. The only one I don't have on that list is Switzerland, because I naively still think Switzerland is mostly independent. But obviously, I don't even think that's the case. But you know who the biggest buyer of U.S. Treasury bonds has been over the last 2 years?
Well, I know you're going to tell us.
I want you to do. Who is it?
Oh, you mean within the Eurozone or the Eurozone
just in general? Just in general, who's been the biggest net buyer of U.S. Treasury bonds? Central bank. Do you know?
Well, I'm going to look at your chart and say it's been the Eurozone.
I meant individually. It's it's the UK.
I was going to say the ECB. It's the UK.
No, it's the UK. The UK has bought. I don't know what the ECB owns, but the UK, because the ECB you can't get. We don't have data in the TIC report for the ECB directly.
Right.
The UK has bought like $250 billion worth of bonds since. Yeah, it's incredible the amount that they bought, and then
are they doing it? But I mean, I don't want to sidetrack you, but before we get into the whole, they're doing it to drop our yields to make us lower rates, which is completely makes sense.
Right?
Wouldn't they be doing it anyway because their yields, because their currency? I mean, wouldn't they be doing it anyway?
Well,
because euro dollars are fucking,
Well, I mean, the pound, but the pound is too strong. The pound's $1.27. It's gutting the UK economy. It's destroyed the Tory majority. It's done all of these things. Now we have UK elections that the Rishi Sunak.
Okay. So shit can't.
What I'm saying is that the UK. This is even more evidence of my argument that I've been saying.
Why would they buy the bonds?
They would buy the bonds because they're doing it in order to save the ECB.
That's what I'm saying. There's no real economic reason for them to buy the bonds.
None at all. None.
There's no reason for it.
No, none.
They shouldn't be investing in fucking bonds.
Right. So here's the thing. So everybody, and I'll publish a link to this, to the slide deck that I showed Vince with the podcast, which is that since September of 2021, which is about the moment of roughly Jackson Hole of 2021, 3 months after Powell raises the reverse repo payout rate 5 basis points above the Fed funds rate. And we have an epic rise in the reverse repo facility up to $2.5 trillion. The EU zone has bought over $820 billion net on net since September 21. In the early stage of that, Japan and China were selling. Now China is still selling, but Japan is buying again. Okay, and the rest of the world is kind of like, and everybody else is kind of like meandering around. There's been some net buying recently from them as well, but and this data, of course, is only up to the latest report, which is as of March of this year, because the TIC report is always 2 months in arrears. So this has been the thing. This has been part of the reason why I've been so steadfast in refusing to back off on the argument that the Fed is trying to destroy the ECB. Okay, and Britain has became a captured pawn, and part of the reason why they needed to get Brexit destroyed was in order to get control of the Bank of England and City of London and all of that stuff as well. So, and the funny part about this, Vince, and this is the part that I find hilarious, is that on the same slide, I also published, of course, because I did this on May 31st, or after the monthly close, the U.S. 10-year monthly chart, which is clearly has the U.S. 10-year yield in a new bear run, from a low of under 4% to upwards around 5%. And they've been upwards about 4.7%. Now today, as of Wednesday of last week, we were at 4.7% on the US 10-year. Today we closed at 4.277. They've moved the freaking bond market like 40 basis points in less than a week. The last time we saw that was in October.
Right.
And
that's just throw a little color in here. What happened in the last 5 days coincided with all this, we're going to have a recession, everyone needs to ease, that I've been seeing at the economist side. And I was like, anyway, but yeah, it's everyone really wants this recession, or they want the threat of one anyway.
Well, they want the threat of one because they need to, again, this is about political pressure, I think, on putting more pressure on the Fed. I keep going. If you think you're sick of Elizabeth Warren now, just wait 3 months.
Right.
So, I mean, but this is not the only reason why I want to talk to you today. So now let's think about, with the ECB cutting right? Why would they do this? I mean, this is where I think, I know I have my answer for this and I can do, but I want you to like, why would, given all of this stuff, why would they do this? It's because, you know what I mean? Like, I mean, what does this imply? This massive forced move into buying U.S. bonds on the age of the ECB cutting rates and diverging from the Fed. What does this imply? And I mean, to you, I'm asking you this honestly.
Oh, yeah. Yeah. My conclusion, okay. So looking at the ECB in Europe in general, they have been willing and relatively happy tracking stocks for what the U.S. Fed does. But, as you mentioned, after Jackson Hole, and then we started on our rate hikes in 22, they started to separate. And you saw that evidenced as well with Japan. Although I know that Japan was touching base with us before they were selling. It wasn't they weren't just blindly selling or blindly buying. Anyway, I guess what I'm trying to say is that Europe, looking at itself, said, oh shit, we can't depend on Uncle Fed anymore. And they do need to ease for the, if you're looking at it digitally, the case to ease versus not ease. The reasons to ease are we are in a recession, number one, or we're heading towards a recession. Number two, our interest rates are causing us to hemorrhage and we're losing a lot of money. And we raised them so much before because of that inflation that we had in the winter. A lot of that was energy based. So energy is lower, or it's under control, at least for now. The economy is weak and inflation in general is coming down. I believe that the ECB is going off of real data and the US is going off of official releases. And what I mean is the US, the Fed will say the real-time data, the stuff they see on a day-to-day or week-to-week basis, says that inflation, let's say it's 2.1%. But until they get a full monthly report that says 2.1%, they're not going to ease. So Powell has been saying, I'm no longer going to use short-term volatile data to make my decisions. That's what got me in trouble before, and I'm not going to do it anymore. So for a principled reason, he could say, I'm not going to ease. Europe, on the other hand, is like, fuck, we have to go with the more shorter, more real-time stuff. We're going to ease. Not to mention that if it's nasty winter, then natural gas and energy prices are going to go up. They're not going to be able to ease in 6 months. Okay. Let's say Powell eases. If Powell eases now, they're going to be hiking a year from now. So the ECB has to ease now. They got to do it now, or they're not going to be able to do it, because after our election, whoever's in charge is either going to ease and ruin the market or raise because Powell eased early. Anyway, the point is the ECB has to ease now and pray for the best. So I understand that, but I was not aware that they were buying so many of our bonds. They want to force. I mean, I'm not saying that they can manipulate the market, but they're betting on the Fed easing and a bull steepening for stocks. And in fact, what Europe is doing is consistent with how our stock market's performing too. Sadly, everyone is betting that there's going to be an ease. So either there's going to be an ease now, or Powell's not going to do it and he's going to be replaced in 6 months. So the ECB is just front running the Fed.
Well, they can't replace Powell in 6 months. The president can't recall the Fed chair. Everybody's like makes this point that they can get rid of Powell. Powell's in there until February 2026 unless they kill him or he resigns.
Well, I think in 6 months he's going to consider resigning. How's that? I'm not betting on it. I'm not betting on it. And here's why. I mean, just thinking about his legacy and thinking about it without being cynical. If Trump wins, he doesn't want to be there. Okay? Because Trump's going to, in my opinion, if Trump wins, he doesn't want to be there because Trump's going to demand easier interest rates because he's going to reduce fiscal spending, or at least say that he's going to reduce fiscal spending. So a Republican's going to reduce fiscal spending, increase the effect of monetary policy. A Democrat's going to do the opposite. So he doesn't want to be there if Trump wins. If Biden gets reelected, I don't think he wants to be there anyway, because he can also say, I got it to 2%. I'm out of here. Go fuck yourself. I'm getting a job at Citadel. And I think he'd rightfully be able to leave, not be Arthur Burns. And the next poor bastard is Arthur Burns. That's
a fair way of looking at it. I think that, but the other side of that is what I think is more what my base case scenario is different from that. I'm not saying that your base case is wrong. I just
but it's not my base case. It's my 20 delta, 20% chance of happening. It's bet.
Okay.
It's my bet.
Okay.
Yeah. It's my
fair
gambling.
enough. Okay. That's fair. Okay. Because when I would go with that, and I would put 20% on that as well. My base case is that Powell's going to ride his entire term out. He's not going to ease until after the election or just around the election where it won't matter. In order to bring a tailwind in. So if Trump is one, allowed to win, and two, allowed to actually take office, then Powell can ease by 50 or 75 basis points, loosen credit markets up a little bit, let some of the pressure off, give Trump the opportunity then to get some fiscal control under, do what you suggested. And all of Trump's bloviating about wanting to go to lower interest rates and go back to the zero bound or whatever, he'll be quietly taken aside by the real movers on Wall Street, i.e. he and Jamie Dimon will sit down and have a fucking talk, and the old Greek bastard will look at him and go, no, this is part of how we win.
Right.
Now, shut up, and we have a plan, and you go after Biden and Hillary and everybody else while we take care of the rest of this. And I think that that's what's going on here. And Dimon has made it abundantly clear, and he's in his very avuncular kind of Jamie Dimon way, and saying, like, look at things are pretty good, and America's still good, and he still pumps America, and you can tell that I believe that about Dimon. I think Dimon is genuine in that respect. I really do. He's disingenuous.
There are things he says that are genuine, patriotic, and at the same time protecting his interests. And I recognize that in some of the things.
Exactly. And why would you expect him to do anything less as the head of as the CEO of JP Morgan Chase?
Right.
Duh. Like, exactly. Right. So, okay. So from that perspective, then you have to ask yourself, okay, what is it? What I was trying to, what I was hoping, or not hoping that you would hear from what I think why the ECB is cutting here, and what it implies is that things are far fucking worse than the placidity of the markets to this point have, up until the last week, have been, and that they want to sell the argument about a recession, obviously, because they need to front run that and preload that, because when their ECB is cutting because German banks are on the verge of collapse, because there's big problems and they need to cut. And this is, so when we think about it that way, look at what they did with the U.S. 10-year, look at the amount of movement they got, and then look at how little the German 10-year moved.
Yeah, you mentioned that off the air, and I think that's really important because, well, I mean, look, if you're buying U.S. bonds with either the intended effect or the resultant effect of making it easier or making it more obvious that the U.S. Fed could ease, you would expect at least to have some trickle down into your own bonds. And in fact, all they did was they made the German bonds look worse.
Right. Well, and the thing is that previous to this move, okay, so this is FYI, because I track the German US 10-year spread on a daily basis, and it's been one of my things for the last couple of years. Lagarde earlier in the year pushed that spread to 2.1%, meaning that German 10 years were trading at 2.1% below the US 10-year, which is very high. It's been running. She's been trying to hold it around 1.8%, 1.9%, and it blew out to 2.1% because the American 10-year started to sell off, and so she was holding the German 10-year down between 2.5 and 2.6. Then they orchestrate a move to move the U.S. bond market down to 4.3%, and the German 10-year doesn't move.
Right.
Okay.
Right.
So first they start to sell off, and they spend a lot of money to hold the German 10-year in place. And then when the They engineer. Then when they spend a whole lot of money to move the 10-year U.S. bond down, the German bond doesn't move with it.
Intervention doesn't help the German bond, it seems, in
Right.
any way.
Right. Either on the upside or the downside.
Right.
This is the moment I've literally been waiting for 3 years.
So if the ECB eases, then, and I say this sincerely, what happens to the German bond?
I'll be honest with you, Vince. I think it goes up. I think it's a sign of weakness.
You mean the yield goes up?
The yield goes up.
Yes,
I think the long end of the German bond, she loses control of the long end of the German bond.
Right. It's kind of like a version of what Trust did, right? If you're going to ease short-term rates and the market likes it, then it'll reward it by buying your long-term bonds because it feels that inflation's under control and it's time to ease. But if she's easing rates and the market says, no, you shouldn't be doing this right now, then the market's going to say, for an inflation point of view, well, you haven't really squashed inflation at all. It's just sleeping, and we're going to punish you because whatever you're doing now down the road is going to be worse for your bonds. And I believe that's a big deal. Yeah.
Now let's tie into oil prices.
Well, the oil prices are.
What do you think is going on in oil prices? I mean, I know what I think about oil prices, but again, I don't believe we have real markets anymore. Like,
no, we don't have real markets. I'll tell you what I think is going on with the oil prices. And again, it's from a domestic political comment. I don't usually like oil is a very big. Obviously, it's geopolitical, but come election time, oil is very political. And here's what I mean.
Mm-hmm.
When George Bush W was running for re-election, I was trading oil, and I was trading from the short side, and I had a good trade. I made a little bit of money, and oil was trading in the 70s. And I remember making a lot of money on this short trade in oil as the Republican convention was going on. And I didn't understand why it moved so much. It was almost like a miracle. So I called my buddy up at Goldman, and I'm like, why did oil go down? This is me being naive, right? I'm talking to a mentor, so I've got to really, really be humble, or he'll just fucking get mad at me. And I'm like, why did oil drop during the Republican convention? Republicans, it's like, it's Halliburton and it's Cheney. And he's like, oh, no. They love oil. But during the convention, they don't want oil to be in the headlines while they're talking because oil had been rising. And oil really crapped out. And I go, oh, he goes, yeah, it's a marketing thing. So the Republicans, whoever's in power, doesn't have to be Republican, but whoever's in power taps their relationships and says, I don't want oil stealing headlines from me while I'm on the podium. And because oil had been spiking, right? So now that was he was on the podium, and I was looking at the market going, oh, it's down $1. What did he say anything about oil? No. All right. Well, so long story short, I believe, and I've been watching the Biden side of this, and you're going to give me the Euro side because I think that's just fascinating to add to. But the Biden side is, since the flare up between OPEC and the U.S., or say OPEC and Biden, and since the flare up between Biden and U.S. oil producers, that's done. They're not airing their public laundry anymore on that. Now, Saudi Arabia and the U.S. may be on the outs, but they're pumping oil on the QT, in my opinion. We're selling futures on the QT, in my opinion. The oil companies are in good stead with the federal government again. They're drilling for lithium. Anyway, Biden needs oil low. So that's why, before we get into the Europe thing, I'm like, look, if you look at everything in the world makes sense except for stocks and oil. Well, maybe oil does make sense, but stocks are too high and oil is too low given the price of gold. So oil's being, like, they're not manipulating gold right now. They're manipulating oil. And as a result of that, as we go to the election, whoever's in power doesn't want oil in the headlines. The most important thing for inflation that people see on a daily basis is gas prices. And we're heading into summer, and that's it. So now you're going to explain why Europe is involved in this, and I'm not going to disagree with you because this is also bad for Putin. So, yeah. I think it's fine.
I'm gonna put some finer points on what you just said. They've moved the wholesale price of gasoline down from $2.80 a gallon to $2.34 a gallon in a 2-week period. RBOB gasoline futures are down like 40 or 50 cents. FYI.
And the CTAs are short making money for a change. Jesus Christ.
Yeah, 236 a gallon gasoline futures. Again, another one of those things. So you're absolutely right. I agree with you that the Biden administration needs lower oil prices. Europe needs lower oil prices and a stronger euro, which they're getting at the same time, because let's broaden this conversation a little bit more. Sure. Let's go back to all the arguments I've just been making. If there's liquidity issues within the European banking system that is forcing the ECB to ease, would we expect a run into or out of the euro in the short term over a 1 or 2 week period?
Well, I mean, if I think they're going to ease, you're taking your money out of the euro.
No, if it's a short-term liquidity problem, you're going to see a run into the currency because everybody needs freaking money at that moment in time because there's mismatches across the credit spreads or across like. You're talking about they're going to ease or they're not going to ease. Even if they're going to ease, you would expect if you're talking future discounting guys are thinking the euro is going to get weaker. But if the ECB is easing because there's problems in the underlying markets and the credit markets, then we're talking about a run into the currency.
Right. All right. If you ease, you're going to take pressure off of the tightness in the currency. But the reason you ease is because you have liquidity problems, and that would mean there's too much money parked in the currency and say not in stock. So it's like tightness versus ease. Yeah, I get it.
And so we have a tight currency market or people scrambling. Just think of it this way.
Right.
I am worried about being able to make my next mortgage payment because I lost my job. So I don't spend money on going out to dinner. I leave it at the bank. People don't buy blah and they buy and they hold on to cash.
Yeah, that's flight to safety, so to speak.
Yeah, it's a flight. In a short term when you're seeing incipient credit stress, there's always going to be a run into the currency. It's going to be out of risk assets like gold, like oil, like silver. So it's not even a manipulation of gold and silver prices. Okay. No. It's just a natural reaction of what happens if there's gold getting shellacked down to 23.10, silver getting shellacked from 32 down to 29, Bitcoin not moving at all for 10 goddamn days. These are all indicative stocks getting murdered.
Right.
Okay. And then the leftover, and then at the same time, the central banks are buying the U.S. bonds in order to try and create to try and push yields down across the board in order to alleviate any interest rate swap stress and derivative markets and whatnot. Stuff I only vaguely understand the mechanisms of, but just understand that these are the natural reactions that people have if there's mismatches, there's time mismatches within the debt structures that the people have to make their payments. This is what happens, right? People are, when they're cash poor and they got high servicing costs, they're going to hold on to more currency. It's just the way it is.
Right.
So then we have all of that's happening, and Japanese bond 10 years moved above 1%. The BOJ is starting to intervene in the yen market to cap its rise. And it's right there. Like it's all sitting there telling you, and the big one. European parliamentary elections are this weekend. They are killing and stabbing and destroying all oppositional members of parties across the board in order to try and ensure that the European parliamentary elections don't end with a populist uprising at that level. Because I don't know if you know this or not, Vince, and I'll remind everybody, the European Parliament, for the most part, is not a legislative body. But one of the things they do get to do is to have influence over the picking of one of the 3 EU presidents. And if you get a populist uprising and that coalition wins, then they're going to get to pick whichever one it is, the president of the European Parliament or whatever. And that's going to lead to not having everybody on board pulling in the same direction this fall. And that's going to change the dynamic within the EU in a functional way. And they can't afford that. And if you look at the way we're literally just now shooting people, Robert Fico in Slovakia, 2 members of AfD in Germany have been brutally stabbed in public in the last 2 weeks. Okay.
Yeah, right. That's
Marine Le Pen in France and Meloni in Italy both came out and said, AfD, they're proto-fascist, and we don't want them a part of our coalition. Like, this is real, honest to God, arm twisting behind the scenes happening in order to stop the populist uprising and the European parliamentary elections. I'm sorry, I've seen a lot in my life. These people are fucking frightened, and the credit markets are sniffing it out. Is what I'm arguing here, and they're desperate to try and hold this under control by bombing the price of oil and bombing the U.S. Treasury markets, because that's all they got left.
Well, I mean, I think even if I'm not intending to make Powell ease, I'm going to be doing that anyway. If I'm looking around and I'm a moderate and I see the dissension or the what's the word, the argument at the ECB level, like you're talking about, and people getting stabbed, literally, people getting shot, literally, and the euro is too strong. So I think that Europe is going to ease. I'm gonna push back just to give you the other side of this, right?
Sure.
Just because I'm making this up, but the pushback is, I'm a European. I don't have any intention. I don't know that the Fed's going to ease, but I know that we have to ease, and so I'm going to put my money into treasuries. Because the U.S. Fed's not going to ease. So why is that wrong?
It's not, but why would you push the yield on the U.S. 10-year down this far, this fast?
Yeah, that's right. It's too much. You're right.
I mean, I can buy 5 or 10 basis points.
No. Had I not seen this chart that you showed me, I would be like, "Fuck you, Tom. You're wrong. I think this is just interest rates." And now I'm looking at this going, and I'm like, my God, they're buying an awful lot of treasuries in Europe. What the hell are they doing? Is the Fed asking them to buy treasuries? Does Powell, and this is me, does Powell want the 30-year bond to yield 2%? No, he doesn't. Because if the 30-year bond yields 2%, then he's got to lower short-term rates, or we have a major recession or disinflation or deflationary. He doesn't want the curve to be inverted anymore.
No.
He wants it uninvert. He just doesn't want it to uninvert from the short-term rates dropping. He wants the back end to go up. So then he can throw his yield curve control in there and stop it. But
then he can cap rates and have a nice, that's fine. I'm all over that. But
so now I'm looking at your chart. But now I'm looking at your chart and I'm saying, all right, so if I know that Powell doesn't want the yield curve to go to 2%, the 30-year bond to go 2%, because he wants. Again, this is Zoltan Pozsar, very recently said this. The yield curve does not exhibit enough term risk, meaning from front to back, there's not enough term risk, meaning you're not compensated enough to own a 30-year bond. And so he's saying that the Fed wants the 30-year bond to have a higher interest rate. So eventually he's going to come in and cap it with yield curve control. But between now and then, that's going to allow him to get a steeper yield curve at the same time without lowering rates. And banks are profitable when you have a steeper yield curve. And a bear steepening is okay if the stock market is already on all-time highs and coming off. But driving yields to 2%, bringing this back to Europe. So I look at this and I go, is Powell telling Europe to buy fucking US bonds? No. So had I not seen this chart, I would say you're crazy. But okay, so Europe is buying a lot more bonds than they should. That's it. And we're not telling them to do it. We're not telling them to buy those bonds. Maybe the Biden Davos crew is, but we're not telling. I mean,
clearly Janet Yellen is working the yield curve for her own benefit to sell the narrative that the U.S. is entering a recession and it's all the Fed's fault.
Oh, yeah, absolutely. If they don't ease rates, I'm going to have to spend more money fiscally. And see, that's the thing. Now there's a pushback on the fiscal stuff. People are saying, wait a minute, you're spending all this fiscal stuff and nothing's coming about it. So there's pushback at the legislative or congressional level that people are now aware of this fiscal dominance, and it's making it harder for her to spend more money, obviously. So
Exactly.
she needs them to ease. Yeah.
And I think also that the markets are beginning to sniff out. That's why the bear steepener trade keeps trying to happen in U.S. yields, but then it keeps getting short circuited,
Right.
and because the markets are sniffing this out, that we need higher rates, and that Yellen can't keep doing what she's doing, and yet she continues to do it. The woman is a traitor. The woman needs to be tried for treason and hung up above the Washington reflecting pool and fed to dogs. Well, okay, not dogs, maybe hyenas, because I like dogs too much to feed Janet Yellen to her. To any dog that I know. I mean, even dogs I don't like, I wouldn't want to feed them Janet Yellen. It'd be like feeding a dog Hillary Clinton. That would be terrible too.
Think about this too much. This is a little bit scary. Which animal would be appropriate to eat Janet Yellen, Tom?
Oh, maybe hyenas. Okay,
right. Exactly.
I don't really like Jack Russell Terriers, so okay,
right.
fine.
Now, that would be fun to watch.
Yeah, it is a little disturbing, but that's between me and my therapist, and it is what it is. So now, remember, as I've said many a time, like we've decided that I have the entire cast of Full Metal Jacket rattling around in my head.
Right
now, when we, with all these things in place, it's really obvious what they're selling here, and or they're going to try and sell. Now, let's also remind everybody what's been happening. Why was the Trump conviction so goddamn important, and the inciting incident for this entire narrative flip? Well, because they've destroyed the U.S. rule of law with this thing.
Right.
And then on Monday we open up, and Berkshire and the New York Stock Exchange amazingly has a blip, and Berkshire Hathaway goes to zero.
Right. And
I mean, Bloomberg, why don't you pull the other leg and play fucking jingle bells? Like, you're trying to tell everybody that the United States is sinking into clown world, and nothing bad is happening in Europe. That's the narrative.
Well, I think what I want to add from a Powell Yellen, dyad is they're not. I mean, this is obvious, right? But I want to say it anyway. They're not on the same page, right? And anybody who listens to your stuff knows that. And not only are they not on the same page, they're working at cross purposes. I mean, I think we talked about this before, but when SVB went under, Janet Yellen was probably knocking on Powell's door saying, "I need you to ease, I need you to ease, I need you to ease." And he said, "I'm not going to ease. I'll create a special vehicle." BTFP was launched, et cetera, et cetera. But now what I'm getting at is the relationship is so. And another thing Posar very recently said was, he said the Powell, the Plaza Accord. Well, he said the Powell Yellen unaccord. He wanted to say discord, but he called it the unaccord. And I'm like, oh yeah. And so taking that concept and just painting throwing an overlay onto what you're saying. Yeah, Yellen is going around the world quite unsuccessfully in some areas like China, and quite successfully in some areas like Davos-led Europe. And she's undermining the Fed's agenda. And that is, and I see that. I saw that, but I didn't really I kept focusing on China, which is a big deal. And we're not going to talk about it now because I'm still wrapping my head around some things there. But if she fails in China, she pushes a button in Europe. I just see her doing everything she can to put pressure on Powell externally to get him to ease, so she's not the bad cop.
Yeah,
that's what I see.
And I want you to. I don't want you to shy completely away from China here.
Yeah,
because the reason being is because now we get back to gold and we get back to silver, and in some ways we even get back to oil, because who's not in control of the gold and silver markets anymore?
Well, the U.S. isn't. The West isn't. Right.
Let's go back to the last two times that you've been on the podcast. Now let's go back to all the things you and I've talked about previously, and how the arbitrage between Shanghai and London/Chicago continues. And what is that doing? What do you think that's doing to this? Now that you have this picture in your head, now let's talk about gold and silver arbitrage stuff. I think I know where you're. I think you can see what I'm laying down here.
Yeah. I'll paint the gold and silver arbitrage situation, or the gold arbitrage, because that's the silver arbitrage is not going to happen, at least not the way we want to. Anyway, and then I want to project what I think is happening right now between Yellen and Xi in their conversations. All right,
Fair.
so in previous conversations, and something that I've studied for years, is that in any normal business, and we're talking about gold here specifically, in any normal business, in commodities, the region of demand determines price eventually. Okay, not the region of supply. So if you pull the oil out of the ground in Saudi Arabia and you sell it to the US, we determine the price. Demand determines the price. If we don't want it, price goes down. If we want it, price goes up, because suppliers aren't really in control in raw commodity pricing. Okay, so now that keeping that model intact, the demand for gold for the last, say, 15 years has been steadily increasing towards the east. And that has been at the forefront of that has been China. All right. So if the commodity region of demand determines price, what happens? Well, who's supplying the gold? Forget about the miners, right? We know what they're going to pull out of the ground. The demand is in China. The supply is coming from the West, because we're the old money now. We're the declining civilization. We have the wealth that's going to be mined by the new wealth that's coming out. So over the last 15 years, the demand was in China. So I'm a gold guy, right? I think I'll move my office to China. I'll build a vault in China. And it's like, let's throw some futures on China's exchange. Let's keep it in dollars, though, because the dollar is a great, the global reserve currency. And then after a while, China, has all this in place for the last since 2014. They've been very active on this. And now the demand's there. The vaults are there. The vaults are in Singapore. The exchange is in Shanghai, and all the other demand is there. And plus, we've got we don't want treasuries anymore. So we want more gold, because it's the only other tier one asset. And so the pricing starts to gravitate there. Now, the dollar is the dominant price in the world. So you're going to see dollar pricing have an effect on, it's not a simple arbitrage from that respect. But what ends up happening is China says, we'll buy all the gold that's lower than the price on our exchange. And so that gold has now been migrating there since the first one that I saw was, and I actually broke this on your show because I had just done the research. I'm like, I got to tell someone this. It was in October that I'm pretty sure it was JP Morgan. I'm not sure, that the first arbitrage from US COMEX to China happened. And that's been going on at various instances ever since. Anyway, so the pricing power is the last thing that migrates to the region of demand. And mind you, we haven't lost all of our pricing power yet, but the pricing power is growing in China, and it's kind of growing in fits and starts. And now it's spilling over into silver, and silver is another whole thing, in the sense that the silver spread between China's price and US price will get a lot bigger, but it's not as easy to arbitrage physically, because you need 80 times the space to ship your silver from the West to China. Anyway, I'm sorry, you're about to say something? Oh, okay. No, I see. You're muted.
I'm on mute. Never mind. I'm sorry. Yeah, no, I was agreeing with you.
Yeah. Your add-in was good. So to wrap that up before bringing it back to your favorite mushroom head, Yellen. So the arbitrage exists now between the U.S. and China. You can laugh. You got your own mute again. It's funny. I want them to hear you laughing. I think it's a pretty good one.
That was great. That was hilarious. I was just trying not to
mushroom
interrupt.
Head. No, I mean, that's her haircut, and that's her choice of psychedelic drugs. So that's why.
Yeah, she really did put the whole bowl cut on. All she had to do was put red streaks in it and some white polka dots. It should be good to go.
Exactly. Right. So basically, China's saying, look, if you you think gold is a global commodity, but you're going to allow our price to be different, then it's going to globally migrate. We'll send you our immigrants, you send us your gold. That's the trade that's going on in the West with the East right now. So they're taking the gold and satisfying their demand. So until their demand is satisfied, the price discrepancy will continually be arbitraged one way or another. Now, why is this important? Or, I'm just beginning to piece this together, but why is this important for, I know gold revaluation, et cetera, et cetera. We all think it's going to happen. A lot of the more aggressive people think it's going to be an announcement overnight. I don't think so. I think gold revaluation, along with Bretton Woods 3, is a process, not an event. So here's what I think. A conversation, if she has the brain power to do it, a conversation between Yellen and Xi would be like this. Yellen goes over to China and to Xi and says, she's a little delusional, okay? She's a Western bubble girl, a little bit delusional, and Xi is a pragmatic realist who really does have to answer to the CCP. All right, so she goes over there and says, dude, I need you to buy more treasuries. And he says, I need you to weaken the dollar. And she says, no, and this is out there. We need the yuan to be weaker. We think you need to debase or devalue because you have a deflationary problem. And if you don't weaken the yuan, you're going to have economic problems. Xi says, I agree. We do have problems. We have a plan. Don't you worry about that. We're not going to weaken the yuan, at least not the way you want to. She leaves, the U.S. bond market tanks. That was like in July of 23. That's when like the day she landed there, the bond market just swooned all the way through October. It was unbelievable. It was like a Kramer prediction. So that happens, and that's when I paid attention. And so now we're going to tie this into gold. So she goes back and talks to him again, and she says, and now I'm making this up, but this is what I think is going on. I think it's like, listen, because now I'm seeing more rattles about China needs to weaken the yuan. Okay, so China needs to weaken the yuan, Yellen says, and Xi's like, we're not going to do that. See, Europe. This is Xi talking to Yellen. Europe doesn't like the dollar being so strong against the euro and the dollar being so strong against the yen. And those currencies in general have weakened against the dollar, even while our currencies have strengthened. So the G7 partners are crying uncle against the dollar. They need you to ease. They need you to debase your dollar. They need you to do something like that. And so now she's saying, again, I think she's a moron. I really do. I used to have a lot of respect for her. I'm like, I used to have at least neutral respect for her, but I think she's a moron. And I'm not going to get into it, except, right, so he says that to her, and she says, well, we can't ease the dollar. We need you to ease the yuan. Okay, fine. They go back and forth. And he says, I'll tell you what, you don't have to ease the dollar. We're not going to ease the yuan, but you don't have to ease the dollar. You can leave the dollar where it is. Just let the price of gold go up. And she says, well, I don't know what she says. I think she says yes. She doesn't say, but someone with power says yes, slowly over time. And he says, okay, well, let's see how slow it actually is. Anyway, I think every time Yellen goes to talk to Xi or even Europe, it's a version of a Plaza 2.0. Okay, Everybody wants the dollar weaker. Here's us coming with our terms to do it. We did it in Plaza Accord. We did it to Japan. And, you guys are all going to listen to us because we're the U.S. And Europe's like, we're still waiting. And Xi's like, no, you've got to weaken. Like, you're going to do it on our terms. And our terms are, if you're not going to weaken the dollar, you're going to fucking let the price of gold go up. Now, I think, and I'm not the first person to say this, but I think when Xi went to California, and he met with Biden, he probably met with someone that had some synapses working. I think they discussed that a little bit, and I think it was kind of like an off the record. We've had a Plaza Accord 2.0 going around, and Yellen's been trying to fucking negotiate. Okay, we'll weaken the dollar, Xi, but you need to buy treasuries. Fuck you, I'm not buying treasuries. until you weaken the dollar. In the meantime, I'm going to buy gold, let the price of gold go up. So I think we're in the process of gold being revalued because of that.
I agree with you, and I'll add one more hypothetical Z statement coming back on the other side, which is, and you need to fucking back off in Taiwan and stop trying to and tell Tony Blinken to put his fucking dick back in his pants.
Like, I know
this is not difficult. You guys want to run around and dictate terms to the entire freaking world and keep the dollar strong and make us buy treasury bonds. You can't have all three of these things consecutively or concurrently. So guess what? We're buying gold. You fucking deal with it.
Right. No,
I don't think it was anywhere close to as cordial as you just laid out.
No, I don't think it was either. I don't think it was either. You brought up Taiwan and
there's one more point on this, because remember what was going on during the Yellen mushroom trip to Beijing, which was that the NATO summit was going on at the same time, and we were making all the overtures that we were going to bring Ukraine directly into NATO in order to try and get Russia to back off.
I remember that. That was like ridiculous.
And the Chinese did actually do some buying of U.S. treasuries after she left. And the whole narrative was Ukraine doesn't get to go into NATO. And Ben Wallace, the soccer hooligan defense minister from the UK, who was supposed to take over, got quashed as a NATO general secretary under Biden's order, and Jens Stoltenberg is still there.
Right. Biden came out. I remember that. Biden came out, or was it what the hell is his name?
It was just reports that it was just reports that Biden put the kibosh on Ben Wallace. And then 2 months later is when Liz Truss is deposed as Prime Minister of the UK. Queen Elizabeth II dies, and BlackRock shakes down the Bank of England over the pension funds.
Right. The pensions.
Yeah. Yes. Yeah. And that's why when I showed you earlier, and this is saying again, same slide deck that had the chart that Vince and I've already talked about, in the very same slide deck again, which will be in the show notes to this, I go through and mark the UK gilt 10-year versus the US 10-year, and the UK gilt versus the German 10-year, and the major events of the last 2 years, including the deposition, the coup against the two Liz's, Yellen's trip to China, and all of this stuff. And how the turns in those bond spreads line up perfectly with all of those events. So, like, it's all part of So the geopolitics, the finance, and it's all about, and it wasn't even in the German bond spread that it's all about London. London was melting down. The UK gilt market was actually the one melting down.
That was a disaster with the trust mini budget. I remember that going, oh my God, the bond market. This is what I said. My knee-jerk reaction was, oh my God, the bond market doesn't want fiscal austerity. It wants more money, and the bond market crapped out. I was like, wow, that's crazy. Anyway,
right. So it's like, I think all of those things are tied together. And then I think the solve for all of these people's problems is higher gold prices. Because all the balance sheets in the G7 in the West, except for England and except for Canada, who don't have any gold, but everybody else who has gold can fix their holes in their balance sheets by allowing the price of gold to rise.
That's right. And I'm thinking about Yellen's response if she had a brain, and she would say to Xi, well, we can't let gold go up because then it would make the dollar look bad. And he's like, well, that's not my problem. Like that's
what impose our commodities, your problem. Right.
Right. Exactly. I mean, look, that's why I think you're genuinely going to see the BRICS currency project show an asset class that's a basket of commodities, 40% or more of gold. I think there's going to be silver in there, believe it or not. Whether it's a good idea or not is a different story, but it's going to be in there. And there's going to be other things in there as well. And those are going to be their collective new tier one asset. And there'll be some treasuries in there as well. And that's not going to change. It's almost like it's almost like the American academic economists. Again, Powell's not an economist, right? The American academic economists, political animals, really are in a bubble and they really think that, Xi's just off the reservation, he'll come back, and it's over. It's over. Like, if we don't bend, we're going to break. I really believe that.
Yeah, and it's not just us, and then there's Powell saying we have all the tools and all the weapons we need here in the United States because we're no longer tied directly to the fate of Europe through debt indexing. Again, I'm going right back to my,
Eurodollar.
This is where SOFR versus LIBOR and my hammer and everything looks like a nail. Right. Fair enough. I mean, you can accuse me of that all you want, but at the end of the day,
no, it's been fun. That's going to be on your, look, when you're
on my gravestone,
that's going to be on your tombstone. That's going to happen. I mean, that was like the call. Those were the two calls that started my man crush on you, the Eurodollar call and the Fed tightening call. But we'll break up soon. Anyway, no, those are great.
It'll definitely be you, and it'll definitely be you, not me.
Exactly. Anyway,
no, I think we've gone around the horn on this. I mean, we've gotten a little geeky and a little technical on you folks, but I think this is I think trying to tie it all around together. And I really do think that, we're dealing with, it's like, even I think felt like I spent a little too much time ignoring the European parliamentary elections and how important they are until I really started to see just how hard they were going after AfD in Europe and Germany. I mean, and how hard, and then they tried to kill the president of Slovakia, and then, and now, they're assassinating people left and right over in Iran and blah 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 because they can't kill Putin, so they might as well kill all the leadership in Iran. To try and get somebody to go offside and give them a casus belli. Because here's the thing that's lurking again in the background that I know Xi is worried about, which is that, and this is what Yellen is probably threatened him with, which is, look, at the end of the day, if you don't buy more treasuries, and we go to war we'll just cancel the QSIPs. See, Davos would like nothing more than for the United States to destroy the one thing that is its superpower, that we've never defaulted on our debt.
Right.
We've inflated it away before, but we've always paid our coupon payments. Mm-hmm. And I think that there's a very strong argument to be made that that Europe, in order to save itself, is trying to push the United States into a situation where our lowbrow 3 brain cells are rubbed together to make a spark fucking morons that they've put in power to run this country will go, oh, well, if China doesn't bow to us, then we'll just cancel all the treasury bonds. Like Lindsey Graham going out the other day and saying, we should just nuke Russia because it's the right thing to do for the world. Like, are you?
I know. Can you imagine that?
What fucking planet do you live on? Oh, I know you live on planet 14-year-old can't pass the dead hooker alive boy test. I got it. Never mind.
Right.
But like, fuck you, dude. I mean, this is insane. And but I think we've reached that moment where these are the kinds of cards that are being dropped on the anti-diplomatic table between these players because someone is so freaking desperate to hang on to what power they have, basically squandered. And I'm talking now about old European money, because there's a solve for all of these problems that we've laid out here. But you'll notice we keep coming back over and over and over again to a group of people who don't want to give up power.
Right. It's the feudal lords are just trying to go back to the feudal system all the time,
Right.
Ever since capitalism was invented, and lords and dukes had to marry shopkeepers to stay fed.
Right.
These people are deathly afraid of having to eat dinner at a McDonald's.
Yeah, exactly. There you go. That's a great way of putting it. So, Vince, this has been great as always, and I really do appreciate you taking way too much time out of your.
It was fun. I love it.
Of course. And so do I, because, again, like man crushes are, a dime a dozen these days. So with that said, I think we'll cut it off here and we'll do it again in a couple of months. And we'll see where we are. Here's hoping that we don't have World War III between now and then.
That's right. Or at least that we're making money if it happens. That's a little cynical, but that's a side of me that I don't show too much. But yeah, that's how I think about it.
But it's always right there. Like let's not kid ourselves. All right, man. You be well, and we'll talk again real soon. Well, that'll about wrap it up for episode 179 of the Gold Goats and Guns podcast. I want to thank Vince Lanci for taking most of an evening to sit, chat, and record with me. It was great fun. As always, you can follow my work over at my blog at tomluongo.me or goldgoatsandguns.com. You can follow me on Twitter at TFL1728, and you can sign up on Patreon at patreon.com/goldgoatsandguns for the Gold Goats and Guns monthly newsletter and or the twice weekly market reports and other video and audio content and written content that I put out for the patrons on a regular basis. As far as Vince is concerned, you can find him over at VBL's Goldfix on Substack. You can find him on Twitter at Sorenthek. And we'll do the thing. And all that stuff will be in the show notes. So you guys be well. You take care. We'll talk soon. Keep your stick on the ice.